Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you here as we round down 2022 in December. We're going to talk about some more personal finance oriented topics, talk about savings accounts and banks. Not something that's always an exciting topic, but very important, I think, for many of you watching. I know that to be a fact, as well as myself and many more, as you will see. Andrew's going to talk about the energy sector, one of the most important sectors for this year, and has seen some changes. We're going to talk about China and then recap the year. So we're going to be all over the place, but stick with us. We'll keep it relatively simple and to the point. And we'll start off with those money market and bank rates. This is really one of the most interesting developments for me anyways, and you're just looking at the savings side. So we believe that FEG portfolios are very important for a large portion of your SNEG, but we also believe in the importance of savings rates or savings accounts. They have an important role for many people to backstop and to fund savings needs. So what we're looking at here are two different things. The blue line on the top panel represents the interest rate that's being accrued on money market mutual funds. The bottom is the interest rate being paid on bank deposits. So very similar in terms of investment, very secure, obviously, and unusually very closely connected. But as the Federal Reserve has been raising rates, money market rates have been moving up, but banks haven't been budging. The red line is measuring the spread or the difference between those two. That's why for a long time, and even if we were to extract this going backwards, there's not usually a whole lot of change. But following all the stimulus that was paid out over the past couple of years prior to this one, banks are awash in cash, and they're really not competing, not striving to get those deposits. So it's important. It's an encouragement for you to all at least take a second, if you do have a substantial amount in your savings, to at least shop around and make sure you're where you need to be. Because as we're finding out, and as you'll see, if you happen to have a comfy couch that is your bank account that it's hung up on, you're not alone. This next slide will show you just how much has been left on the table. So on the left part of this chart is how much Americans as a whole have left on the table by not using high yield savings account. Oftentimes these are either money markets or the online banks like American Express or Marcus or many others, several of which we've recommended to you guys through the years. But Americans collectively have left $42 billion on the table during the third quarter alone by simply not just moving that money around. So again, just a gentle nudge to at least take a look around and not leave interest on the table. And then the right panel just shows you how sticky those deposits were. They haven't really moved. That is collectively how much of money accounts are at the top 5 banks, which are just so huge. They have about half the deposits. One would have expected in this environment with that type of interest that people would begin to take advantage of other things out there, but they haven't. So that is all that I've got. I want to pass the baton over to Andrew now to move over to equities, starting with the energy sector.
Yeah, energy feels like a topic we bring up every couple of weeks. As Adam said at the start of the Market Carver, it's been a really important sector for this year. The reason being it's been the best performing sector. And as we have, the topic of inflation has been around this whole year. We got the data out today, this morning it's Tuesday when we record this, and that inflation did tick down a little bit. But we have seen the energy space continue to be fairly strong. It's pulled back, but energy continues to be the best performing sector this year. With the recent pullback in energy stocks, we've actually seen a lot of money flow out of a lot of the largest ETFs that track energy. We often talk about XLE, it's one of the largest, but there are other ones out there. And so something we watch every week is, do we see a lot of money flowing in or money flowing out of some of the major ETFs that we follow, want to keep an eye on. When we start seeing very large outflows, it creates potential opportunity that maybe everyone's abandoned this trade or this sector, and the sentiment towards it has gotten so bearish that it maybe has an opportunity that's going to go higher if price starts to firm back up. And we think this is something that is playing out or has the potential to play out within energy. We're seeing that the most money has flown out of energy stocks really since the last time we saw a dip in the space. And after that dip occurred back during the summer months, we did see a rally back in energy. Part of the reason we think there's still opportunity, there's still some catalyst, not only in the energy stocks but also the commodities, is we just now have one of the largest users of energy, of crude oil, coming back online. Talking specifically about China. China is actually the second largest consumer of oil. You can see in this chart here, second to the US. Actually, it sees the entire European Union. And China's been locked down with their extremely strict COVID restrictions since 2020. They just announced that they're starting to move away, begin to ease their zero COVID policies, meaning that people are going to be able to travel a bit more freely. You're going to see a little increase in tourism, increase in production, all the different the different manufacturing that uses oil and petroleum products should start to increase. And we believe this is a positive long term for oil consumption and the oil demand, which would have an impact then obviously on the price of oil and then the energy stocks. So we think that as China comes back online, that this could cause another push higher, possibly in crude oil demand and the stocks and the commodities as well. So as everyone's left the energy stocks, at the same time we now have a potentially increase in demand, which, like I said, creates that opportunity maybe where we still see some higher prices in the commodities and on the stock side.
Yeah, that's just been a theme of my career that, of course, there's short-term cycles, but energy has been one of those. It seemed to have very long, drawn-out cycles as it becomes a big part of the S&P 500 and then a really small piece. And sometimes just there's a long secular move and just still has all the feels that we're in the midst of that, where it's still a very important sector. I know just one last thing for you to bring us home, Andrew, is this was interesting to me from this week's meeting, is just really how painful this year has been. Inside the S&P 500, there's certain pain spots, but I'll kind of let you cover the chart here. You brought it to the table. It's kind of self-explanatory, but often when we look at the S&P 500, we don't get the full picture of all the pain that's been out there.
Yeah, and so when we often talk about the market investing, you have individual stocks make up the market, and there's been a lot of what I call landmines that have been out in the equity land this year. We've seen a lot of stocks that have gone down 60, 70, 80, even 90% this year, primarily in those growth stocks. A lot of technology stocks have really taken some punches this year. And the average retail portfolio has felt a lot of that, unfortunately felt a lot of that downside. There was a study done and published in Bloomberg looking at what the average retail portfolio performance was for this year. And when the market was down about 17%, the average retail portfolio was down closer to 30+%. A large reason for that is a lot of the stocks that people jumped into last year, they called them meme stocks. Tesla, Peloton, DocuSign, even Apple, Amazon have had some rough periods as well. A lot of these tech stocks, which tech stocks are often what we see a lot of retail investors go after, have really struggled this year. And then we throw on top of that a lot of the cryptocurrencies have also really taken on some pain, dropping significantly, as you can see there by the Bloomberg Crypto Index, down just over 60% for this year. And so it just goes to show, even though the index may be at a certain level, there's been a lot of angst and a lot of landmines popping up this year that has caused some hurt and destruction for portfolios. This doesn't just mean that should continue on the next year. Maybe it creates opportunities, just like energy where it got oversold. But a lot of portfolios, like I said, took some punches this year.
Yeah. Yeah. Thank you for carrying the line load of the work this week, Andrew. Appreciate it. I will make just one last comment, taking you back to the savings rate. I don't want to leave you all hanging on that if you think that hits you. And by the way, this is, oftentimes we're talking to ourselves. I will admit to being one of those with sticky deposits here. Looking at my personal bank account, it hit me around September, October. Hey, not a giant sum, but every little bit adds up. And I was like, wait a minute, the savings account is earning nothing. And it finally compelled me to at least move. And I say all this, that we do have resources. We have cultivated relationships where we can help you. You don't have to go out and do all the research on your own. We can get you into avenues which benefit us none, but can benefit you just simply because we found good relationship managers and good service companies, which is the most important thing to us. So again, if you need help with that, feel free to give us a call, or for anything else where you think we may be able to help, 800-928-4001. And again, thank you very much. Hope you all have a great weekend.